Welcome to the Capital News. I'm your host, Alex Karitis. Today is Tuesday, September 22nd, 2020. Thank you so much for joining me. The title of today's podcast, Government Out of Control. I should just make this the name of the podcast for what's going on and what is coming down the pike. And this is just government out of control globally as well, but that's no surprise to us. Some market performance, some projections out of the Congressional Budget Office, the CBO. We're going to read a little bit about that today. Is the UK going to go on a second lockdown? And of course, the other pair of Tweedledee and Tweedledums, Jay Powell, Chairman of the Federal Reserve, and Steven Mnuchin, Treasury Secretary, were testifying and making comments in regards to the Nobody Cares Act, the economic recovery, etc., etc., etc. First, to market performance, we have U.S. existing home sales highest in 14 years. Sales of previously owned homes in the U.S. increased 2.4% from the previous month to a seasonally adjusted annual rate of 6 million units for the month of August. That is the highest reading in nearly 14 years and in line with market expectations. The need for housing will grow even further potentially, especially in areas that are attractive to those who can work from home. 14 years ago, what was taking place 14 years ago? Oh, right, that's right. The lead up to the great financial crisis, driven by a housing crisis. And there we are, just a short 14 years from that, back at that point. Very interesting, is it not? And of course, this is one of those correlations that is breaking with conventional wisdom, with conventional thinking. As I stated here, since I began this podcast back in early 2019, I said when this everything bubble bursts, and it will be catastrophic. It will be something that we have never witnessed before. And because the everything bubble is the everything bubble, when it bursts, we are likely going to witness and experience a breakdown of traditional correlations. I gave examples. Well, one of these correlations that is breaking down is in response and is in relation to housing. Because typically, when you have a high rate of unemployment, housing prices come down with it. People don't have jobs. They don't have job security. Banks are tightening their lending standards. They're not giving out mortgages. People can't pay. They're defaulting. There's foreclosures. Okay, and down come housing prices. Well, we have 30 million Americans still collecting some form of unemployment benefit. The number of unemployed is even higher than that. A lot of people who are part-time, who don't want to be part-time, but they have no other choice. They have no other option, etc., etc. We talk about this on a weekly basis. That is a breakage. I believe this is temporary. We have people who are obviously wanting to leave the cities because of this pandemic. They can work from home now, maybe on a more permanent basis. So they want a yard, they want some country, whatever. Okay? That makes sense, but what's happening in the process is home prices are being bid up. Asking price, just for the sake of example, make it easy, is $100,000. People are going in, they say, nope, $110,000, $120,000, $130,000, $140,000. There's bidding wars. And we're already starting to see people have buyer's remorse. And of course, part of this is also a function of record low interest rates and corresponding mortgage rates. So this is just an attempt, if you will, at least on the standpoint of lower interest rates, to keep this bubble moving at any cost. And the costs are going to be quite devastating and quite expensive. So this is, in my opinion, I could be wrong, of course, but in my opinion, my analysis, this is just a short-term phenomenon. Once economic reality sinks in, once the several $trillion of funny money dissipates and is really no longer funneling through the system, which is already starting to happen, we are seeing this, economic gravity is going to take hold. And with it, some of those more traditional correlations that might be broken right now are going to go back on track, and then others are likely going to break. I said this was going to happen. This is what we're witnessing. It's no surprise. When we look at the FX markets, the foreign exchange markets, we have the dollar index trading at 94.169, a 94 handle. We were at a 92 handle not too long ago. This has been quite the run-up with the dollar index. Now, this can also be cause for why we are seeing the stock market sell off, in part. This could be a reason why we're also seeing some commodity prices and precious metals selling off, in part. We will see how long this lasts. Now, this is in, I think, at least, a function also of a lot of the funny money starting to dry up. It's made its way through the system. It's done what it's going to do, and that's it. So this is why you have Jay Powell of the Federal Reserve and Mnuchin, the Treasury Secretary, pretty much calling for more fiscal stimulus. They're going to come out and say everything's kind of okay, but there's still a long road ahead, and we need more fiscal stimulus. Therefore, the Federal Reserve can print more money to finance that fiscal stimulus. And of course, it's not stimulus, it's just spending. And of course, it's not free. So when you have this liquidity starting to dry up, there's still demand for U.S. dollars, but there's not as many dollars circulating around because they've already been used up. We've talked about this at length, the dollar doom loop, that type of scenario. The government and the Federal Reserve is well aware of this. We know this by their actions, not so much by their rhetoric, because they're not going to explain to the people what I explain to this audience. They're not going to do it. The dollar swap lines, trying to keep liquidity flowing through the system, what have you. The U.S. dollar, net is going down. It's a process. It takes time. The dollar can have a swan song. It can go to the stratosphere because of how much outstanding U.S. dollar denominated debt exists around the globe. That creates a demand for those dollars to be paid back, for those debts to be paid back. That's how it works. They're U.S. dollar denominated. They got to be paid back with U.S. dollars. These debts are coming due. They can only roll them over for so long. You can only play that game for so long. Understand this. And they've done one hell of a job doing it. You got to give them credit for that, of kicking the can down the road. But there's been no honesty and there's been no leadership. And that's why we are witnessing the economic collapse around the world. That's why we are witnessing global protest after global protest, global riot after global riot. This is just starting. All right? So the dollar index is again 94.159. And of course, that is having a big effect with the cross-currency pairs with the euro, the pound, the Aussie, across the board. A little bit of a rally, a counter rally today on Wall Street, pretty much across the board. Right now, overnight futures trading, we have the Dow Jones Industrial Average up about 0.3%. The S&P 500 is in the red but flat. And the NASDAQ 100 is in the red, down about 0.33%. Japanese markets are down 0.4%. Cash trade right now, a mixed bag across the pond in Europe. Of course, at the top of the podcast, I noted that the UK might be going into lockdown 2.0. You had an address to the nation by Prime Minister Boris Johnson outlining measures that he wants Britons to take to really keep a lid on rising cases that are being experienced around the globe, unfortunately, and basically saying if you don't comply and we continue to see an increase in cases, that it's going to be lockdown 2.0, and who knows, it could last up to 6 months. So that could have a devastating effect on the economy for certain, and politics, everything. Everything is connected. Now, this isn't a small country. The UK is a big country. One of the largest economies, supposed to be a beacon and an example of democracy. talking about lockdown 2.0. This is big news. You also are seeing an increase in cases in France and in Spain and elsewhere. Will they lock down again? Spain is in dire straits. Their banks are garbage. Spain is a beautiful country. I've never been there, want to go there. Beautiful country. Tourism is a huge component of, it's a sizable component of their economy. Well, nobody's going. So that is having knock-on effects, as it is around the globe. This is far from over. You have Christine Lagarde, the president of the ECB, the European Central Bank. She has her high heel, the pedal to the metal. All right, she's pushing down. More money, more money, more money. Let's just keep throwing more euros at the system. You had last week the Bank of England talking about how they're going to start contemplating negative interest rates, which of course means they are going to implement negative interest rates. It's just a matter of time before that comes here in the United States. Now, you have negative interest rates in Japan. It's completely decimated their economy and their banking system. You've had negative interest rates in Europe, completely decimating their economy and their banking system. Now, of course, the UK is part of Europe, but the Bank of England sets their own policy. They don't follow the ECB, tit for tat. So now they're going that way. And of course, the UK did not adopt the euro. They kept the British pound. So there was some flexibility for them. But now they're going the way of the dodo as well. And it's just a matter of time again until it comes here to the United States. And of course, here in the U.S. and elsewhere, if you don't have nominal negative interest rates, you have real negative interest rates when you take into consideration the nominal rate minus the rate of inflation. All right. And these rates, negative interest rates, are only going to go deeper and deeper into the red, which is why I'm a big advocate for precious metals, particularly gold and silver, and other commodities as well, because the inflation is here and the effects of it are going to be felt in the not too distant future by everybody. Let's see. Australia is rallying. Cash trade right now is up 2.3%. Of course, the Australian markets have been getting pummeled over the past week as well, so this is a strong rally, up 2.3%. On the commodity front, we have WTI trading at $39.44 a barrel. Brent is at $41.42, still holding on relatively well considering the dollar strength. Natural gas is at $1.83. Gold and silver getting hit. We have gold spot at $1,886 an ounce, so below $1,900. Haven't been there for a while. Silver, once again, getting pummeled off of the back of a stronger dollar. Spot price for silver, $23.45. To me, this is a big gift. This is a buying opportunity. Uncle Sam's 10-year junk note, rock steady, 0.67. Unbelievable. This is the calm before the storm. Basically, no volatility in the bond market. Again, the calm before the storm as far as I see it. Now, Jay Powell, our pal, and Steven Mnuchin. These guys are out of control. They can't solve anything here. We need more stimulus, more spending. It's not enough. Got to keep going. Can't figure out, they've had several months, can't figure out how to get money into the hands of small businesses. Can't figure it out. If you are one of the largest corporations, not just in this country, but in the world, because your U.S. dollars, your tax dollars are going to bail out global corporations, not just American corporations. They can figure that out. Drop of a hat, that's no problem. They can do that in their sleep. But to get that money in the hands of small businesses who don't have access to the capital markets like these large corporations do, we can't figure that out. We don't know how to do it. Nobody Cares Act, folks. That's why I call it the Nobody Cares Act. Trillions of dollars down a drain, only to get us to where we are right now. Again, 30 million collecting unemployment, some form of unemployment insurance, and the number's even worse than that. Countless number, millions, tens of millions potentially waiting in the wings when it comes to evictions. Okay? Millions who don't have enough to eat and consider themselves underfed. All right, this is the United States of America. Half the country is broke through the various surveys that we've been going through. A significant portion of small businesses have shut for good. They're done. More surveys out when it comes to the hotel industry. Well, if they don't get another bailout or some sort of federal assistance, get this, up to two-thirds of hotels could close their doors for good. Up to two-thirds. Staggering if they don't get some sort of federal assistance. What about the airlines? Well, we have another week until that sham job of a contract between us, the federal government, and the airlines, till that bailout expires. And of course, they've already come out, the airlines, announcing that if air travel doesn't pick up back to normal or pretty close to it by the end of September, first week of October, they're going to have to lay off tens of thousands of employees. But Jay Powell and Mnuchin, they can't figure out how to get money in the hands of small businesses. It's a head scratcher. That Main Street lending facility, barely utilized. Don't want to do it. You have to recall from the Nobody Cares Act and the PPP loans that out of the gate, a lot of banks didn't even want to comply with it. They didn't even want to be a part of it. And of course, the PPP loans were primarily supposed to be used for small businesses. And of course, we're already getting reports of fraud there from people who took the money and then they bought, fancy cars with it, or they left the country. And of course, the mismanagement by the banks, giving it basically to their friends and people that they knew weren't deserving of it, but they gave it to them anyway. How big that number is going to be at the end of the story is anybody's guess. Your guess is as good as mine. But this is why you don't do this stuff, because this is what happens. So the banks really didn't want any part out of the gate of the PPP loans. There was a lot of uncertainty, mismanagement by the government. Wow, what a shocker there. Are we going to get paid? Are we going to collect fees? What happens if they can't pay it back? What happens if they don't comply? Are we going to be the ones that have to deal with the losses on our books? Back and forth, back and forth. Even though the banks get bailed out by us and they are regulated by the Federal Reserve, they can dictate what's going on. It's our money. We should have a say. And if we're going to pass this monstrosity, the Nobody Cares Act, well, you're going to do what we tell you to do. But that's not how it works. They're the bosses. The banks are in control. All right, and we talked yesterday about the BuzzFeed story, that investigative journalism, those released reports, $2 trillion, special or suspicious activity, yada, yada, yada. We went through it. Check it out. Again, we're going to continue to cover that. But the banks can't lose. They collect fees on money laundering. They know what's going on. They collect the fees. They don't go to jail. They're not prosecuted. If something really gets out of hand, then the government has to put on a show that they got to do something. Okay, we'll go after this bank. Does anybody go to jail? No. Who pays the fine, the CEO or the board? Nope. You guessed it, the shareholders do. They can't lose. And if they take that money and they place a risky bet and they make all the money, they keep it. If they take the money and they make a risky bet and they lose it, you bail them out. It's good to be a banker, isn't it? That's simplistic, but that's it in a nutshell. So they, the Federal Reserve, in conjunction with the Treasury Department, through the SPV, that special purpose vehicle, which was created through the Nobody Cares Act, which allows the Treasury Department and the Federal Reserve to work hand in hand. So much for Federal Reserve independence, which we're told about is so sacred. Through the smorgasbord, the alphabet soup of emergency facilities that exist and reside within the Federal Reserve, they can purchase corporate debt, drop of a hat, directly from those companies, or they can even bail out the previous investors on the secondary market who bought those bonds previously. Can't make this stuff up. But it's a head scratcher as to how they're going to get money in the hands of small businesses. Well, a little bit too late, isn't it now? I guess the joke is on the small businesses who have shuttered their doors. This is the travesty. And you think this is a mistake? You think this isn't by design to some degree? Give me a break. This is the system. This is the two-party system. They both signed off on it, 96-0. No votes for America. Check out that podcast several months ago. Actually, that whole series of podcasts that we did back in February, March, and April, you got to go listen to all of them if you want to understand what's going on. And of course, I talk about this stuff too on a daily basis. But if you want to understand what I was pretty much certain was going to come down the pike and where we were headed, go check out those podcasts back in February, March, and April. Because we're living it now. And there's no end in sight. So those two guys, they got a lot of audacity coming up in testifying before Congress, and by extension the American people, telling us that we are on some sort of firm footing with an economic recovery, but we still need more spending. We still need low interest rates. The Federal Reserve stands ready to do whatever is necessary, and that they're going to tolerate higher rates of inflation. Let's see how long you can tolerate higher rates of inflation. Now on to the CBO, the Congressional Budget Office. At a glance, each year the Congressional Budget Office publishes a report presenting its projections of what federal deficits, debt, spending, and revenues would be for the next 30 years if current laws governing taxes and spending generally did not change. This report is the latest in the series. Now, that, of course, is an unreasonable assumption for 30 years, but nonetheless, it still paints a picture. Deficits. Even after the effects of the 2020 coronavirus pandemic fade, deficits in coming decades are projected to be large by historical standards. In CBO's projections, deficits increase from 5% of gross domestic product GDP in 2030 to 13% by 2050, larger in every year than the average deficit of 3% of GDP over the past 50 years. Debt. By the end of 2020, federal debt held by the public is projected to equal 98% of GDP. The projected budget deficits would boost federal debt to 104% of GDP in 2021, to 107% of GDP, the highest amount in the nation's history, in 2023, and to 195% of GDP by 2050. That's only 30 years away. That's a generation. That's why we have lost generations. This is pulling all of that future growth and prosperity from future generations forward to today. This is not the way to run a country. It's not at all, and we're all paying the price. High and rising federal debt makes the economy more vulnerable to rising interest rates and, depending on how that debt is financed, rising inflation. This is from the CBO. The growing debt burden also raises borrowing costs, slowing the growth of the economy and national income, and it increases the risk of a fiscal crisis or a gradual decline in the value of Treasury securities. Everything we have been discussing here at the Capital News for a year and a half since we've been online. More vulnerable to rising interest rates. We have a capital economics presentation of this. Of course, it's on our YouTube channel at the Capital News, and it's right on our website at thecapitalnews.com. Are central banks trapped? Government spending, deficits, everything. They cannot tolerate higher interest rates. This isn't theory. This was in practice. We saw this firsthand when we and also other capital economics presentations, the yield curve. When we experienced that massive stock market sell-off in the fourth quarter of 2018. That was all a result of some Federal Reserve balance sheet runoff and a little bit, and a very small incremental increase in interest rates over a period of time. If you can't increase interest rates during a time when we are told by the president that it was boomtown, it was the best economy ever, then when are we going to ever be able to increase them? Well, we couldn't increase them during the great times, according to the president. Stock market sells off. Stock market has a hissy fit. Thunder Thumbs has a hissy fit. Federal Reserve does a 180. Oh, we didn't mean to do it. That was at 2.25%, 2.5%. I argue if interest rates went back up to 1.5%, we'd never survive. We wouldn't make it. That's what the CBO is also telling us. And of course, they are mentioning how that debt is financed. Well, there's only a few ways that that debt is going to be financed. Increased taxation, inflation, or an outright default. Neither is good. you will experience higher taxes, and you are going to experience inflation. Make no mistake about it. I don't care what Thunder Thumbs tells you. I don't care what Joe Biden tells you. Your taxes are going up. Directly through direct taxation or indirectly through inflation, and inflation is the most devastating and destructive form of taxation that there is. The growing debt burden also raises borrowing costs, slowing the growth of the economy and national income, and it increases the risk of a fiscal crisis or a gradual decline in the value of Treasury securities. So, a gradual decline. Now, they are hopeful that this is a gradual decline in Treasury securities across the yield curve. It could be abrupt. This could be the calm before the storm that I'm mentioning here, with this low volatility, so to speak, in relation to the bond market. It could explode. It could erupt. But you have to understand bond prices and their corresponding yields, right? They are inversely related. So if you have a gradual decline, any type of decline, makes no difference, in the value of Treasury securities, they're talking about the price. So if the price of those Treasury securities go down, then the yields go up. Well, that yield represents our borrowing costs. I just told you we can't tolerate 1.5%. That's my argument, because we have thrown so much more debt and deficits on top of this economy since 2018, and we couldn't handle 2.25%, 2.5%. So I think it's logical to conclude that 1.5% would be the dagger in the heart. We couldn't tolerate that either. So the market, through that gradual decline or abrupt decline in Treasury securities, could cause quite the spike in our borrowing costs. And that's a fiscal crisis. That's exactly what that is. And of course, when they talk about these massive numbers, 195% of GDP by 2050, that being the national debt, I mean, you can talk till you're blue in the face about low interest rates and claiming that this is the time to throw on even more debt to finance one project after the next because interest rates are so low. Well, here's the problem. Our total number of debt, the absolute number of debt, is astronomical. And when you understand compounding interest, which I talk about quite often here and what we talked about at length in our book, The Cynic's Guide to Investing, is sort of that miracle of compounding interest. Now, it can work for you and it can also work against you. It's just math. And what you're going to witness when you study compounding interest at a reasonable rate of return or at a reasonable cost of borrowing, in this case, it's the cost of borrowing. Once you hit that 20, 30-year mark, the chart goes exponential. And that's why debt as a percent of GDP is going to hit 195%. It'll probably be worse than that by 2050. Because compounding interest in this instance is working against us because the total amount of debt outstanding that we have is simply astronomical and unsustainable. And that's why it's going to be paid back with a combination of taxes, inflation, and perhaps even a default. And if there's a default, then it's likely that interest rates are going to go up even higher because now we are a credit risk. The United States of America. Okay? Spending. After the effects of increased spending associated with the pandemic dissipate, spending as a percentage of GDP rises in CBO's projections. With growing debt and higher interest rates, net spending for interests nearly quadruples in relation to the size of the economy over the long term, accounting for most of the growth in total deficits. Also increasing are spending for Social Security, mainly owing to the aging of the population, so demographics, and for medical care and Medicare, and the other major healthcare programs because of rising healthcare costs per person and to a lesser degree the aging of the population, according to the CBO. Revenues. Once the effects of decreased revenues associated with the economic disruption caused by the pandemic dissipate, revenues measured as a percentage of GDP are projected to rise. After 2025, they increase in CBO's projections, largely because of scheduled changes in tax rules, including the expiration of nearly all of the changes made to individual income taxes by the 2017 tax law. So the 2017 tax law, a lot of those effects that went into law are going to expire come 2025 and after. After 2030, they continue to rise, but that growth does not keep pace with the growth in spending, which has been the case for a long time here. Most of the long-term growth in revenues is attributable to the increasing share of income that is pushed into higher tax brackets. So, ladies and gentlemen, this is a government that is out of control. There is no leadership. There is no honesty. The global population is crying out for it, and we're not getting it. You are not going to hear much of any of this discussed by President Trump. You're not going to hear many of this discussed by Vice President Biden in the debates or on the campaign trail. You might hear Biden talk about the unemployment numbers and this, that, and the other, simply because it doesn't look good for Trump. Most of that is politics. Biden doesn't have any structural reform that is really going to solve these issues. And Trump doesn't even talk about it. He just said everything's fine. There's no problems. 200,000 people are dead because of coronavirus. Yeah, it's nothing. You don't got to worry about it. Just keep plowing forward. Don't worry about it. 10 million people, new created jobs, which of course is bogus. Those are just jobs that went back. And again, what's the purpose? Was it because of employers trying to comply with the Nobody Cares Act PPP loans? Is there really demand back? What's going on? So we got a big distortionary effect when it comes to the overall jobs picture, which we talk about on a weekly basis here. But we're starting to get a little bit more of an inside look to the jobs picture because the trend, unfortunately, has not been going in the right direction over the past few weeks, but that is more indicative of the underlying structural issues that are at play and continue to unfold on a daily basis. So they're starting to catch up with reality. That's why you've had Jay Powell, every chance he gets, along with his colleagues at the Federal Reserve, when they make comments that the Congress has to do more, there has to be more spending. And this is why. This is why. Because we've spent several $1 trillion, most of it that we do not have, and this is all we have to show for it. So economic gravity is going to take hold, and it's not going to be a pretty picture. So we discussed a lot of information today, as we typically do. That dollar strengthening is something to keep a lookout for, because if it keeps going, it can have some really negative side effects, if you will, for share prices in the stock market, which is also going to become very interesting politically because the president hangs his hat on the stock market. And, Congress is also paying attention to it as well. So if the stock market really starts to sell off more, to a more severe degree, with greater rapidity as well, will that be the catalyst that says, okay, now the two-party system can get together because they're all concerned about the stock market? Not so much about half the country being broke and facing eviction, but because the stock market is going down. So that just lets you know everybody's priorities, fitting with a government out of control. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Kareitis. Godspeed.